There are a lot of mistakes one can make with crypto investing, but the one we are going to talk about in this video is by far the biggest when it comes to crypto tax planning. I promise after this video you will change the way you see your crypto transactions forever. You can avoid this mistake only if you know about it, and I'm going to show you my exact method to do just that. Let's dive in. In order to understand how easy it is to commit this thing and why it is such a huge mistake, we need to go back to the basics of crypto tax. In Australia, cryptocurrencies like Bitcoin are not treated as money or foreign currency for tax purposes. Instead, they are viewed as assets similar to shares or investment properties. This means there is no distinct category known as crypto tax within the tax system. The taxation of cryptocurrencies is integrated into the existing tax framework. So if you're already familiar with tax concepts like tax brackets, assessable income, taxable income, tax deductions, capital gains tax, you already have a solid foundation to understand cryptocurrency taxation. If these concepts are new to you, I suggest watching this video to enhance your knowledge. We all know that if we sell a share or investment property and make a profit, that profit is subject to capital gains tax. The same applies to crypto, but there are so many ways crypto are considered sold or disposed of, thereby triggering a capital gains tax event. If you sell a crypto, gift a crypto, trade, exchange, or swap a crypto for another, convert a crypto to fiat currency, or buy goods or services with a crypto asset, you are triggering a capital gains tax event. If you make a profit, you need to pay tax on that profit. Other rules may apply depending on how you are using crypto assets for business transactions. Please keep in mind in this video I'm mainly addressing crypto investors, not crypto traders. This video is purely educational and should not be taken as financial advice. Later in this video, we will explore an example, but even if your situation appears similar, you should conduct further research or seek personalized advice before making any decisions. The biggest mistake occurs when people dispose of their cryptocurrency at a profit but neglect to set aside a portion of that profit in the relevant fiat currency in their country or a stable coin that can be readily converted to fiat to cover the tax liability. Moreover, failing to realize that the big tax bill is coming for them, they miss opportunities to optimize their situation to lessen the tax burden. Later, we will explore various strategies to reduce the tax bill. But first, why is it so easy to make this mistake with crypto in the first place? You see, with other investments like shares or investment properties, you cannot simply swap your CBA shares with BHP shares, nor can you swap your investment property A with another investment property B. You need to sell the asset you own first and then use the money to buy another asset. With crypto, however, because of the ability to swap, many people have the perception that,
oh, my money has been kept in the market the whole time. I haven't sold it to real money, so no gains, no tax.
Wrong. My friend John has made this exact mistake and the consequences have been pretty disastrous. John is a 30-year-old IT professional who also dabbles in crypto investing. He got lucky with one of the dog coins and made big buck with really insignificant initial investment. When the coin took off like a rocket, John decided to diversify his crypto portfolio. He promptly swapped half of his dog coin into Bitcoin, Ethereum, and other big names. Shortly after, his dog coin rocket plummeted back to earth, and the big coins also suffered a major correction. Fast forward to tax time, John's accountant told him that he needed to pay the ATO $15,000 in tax. What? John didn't have that kind of cash to pay the ATO. He had to sell some of his crypto to pay the tax bill, this time at a much less favorable price. What's worse, he just triggered another capital gains tax event, although that's a problem for the next financial year. Even if John had $15,000 in cash available to cover the tax bill, therefore avoiding the need to sell crypto at an unfavorable price, he essentially converted a safe and secure asset worth $15,000 into an unpredictable asset like crypto. That money could have been used for a home deposit or emergency fund or a wedding. Regardless what John had earmarked his $15,000 for, such a significant shift in risk exposure cannot be considered prudent. Now you're aware of this mistake, what steps can you take to avoid tax shock and reduce the tax bill? Step 1. For tax purposes, it's essential to treat each crypto asset you hold as a separate entity, rather than considering your entire wallet or crypto portfolio as one. Before executing any transaction, be it a sell, swap, or gift, refer to this checklist. Does this transaction trigger a capital gains tax event? If the answer is no, go ahead. If yes, do I have a compelling reason for proceeding with it? If the answer is no, do not transact. If yes, have I held this asset for more than 12 months? If yes, go ahead with the transaction. If no, could it be potentially more beneficial to wait until after the 12 months? If yes, do not transact and wait until after 12 months. If no, go ahead with the transaction. Step 2. Have a profit-taking strategy that includes setting aside a portion of your profit in fiat currency or a stable coin to cover your tax bill. What would that portion be, you might ask? That depends on your marginal tax rate and whether you have held the asset for more than 12 months. In John's case, his taxable income excluding the crypto gains is $135,000, placing him in the 37% marginal tax rate bracket. Since he held onto his cryptocurrency for over 12 months, he qualifies for a 50% capital gains tax discount. This effectively means that he will be taxed on only half of the gain at his marginal tax rate. As a general guideline, if you hold your crypto for less than 12 months, set aside a sum equivalent to your marginal tax rate from the profit for tax purposes. For holdings beyond 12 months, reserve half of your marginal tax rate's worth from the profits. If your crypto gain is particularly large, be aware that you might be pushed into the next marginal tax rate or several higher marginal tax rate brackets. In this case, the best way to calculate the amount of money to reserve for tax purposes is to perform two tax calculations, one without the crypto gain and one with the crypto gains. For example, if John's crypto gain is $200,000 and he has held crypto for over 12 months, he should first calculate his tax liability without the crypto gains, which amounts to $37,717. Then he calculates his tax liability with the crypto gains. Because he held the crypto for more than 12 months, he is eligible for the 50% capital gains exemption, making his taxable income, including the crypto gains, $235,000. Entering this figure into the tax calculator results in a total tax bill of $81,117. Therefore, John needs to reserve $43,400 from his crypto gains in fiat or stablecoin after taking profits. If John had held the crypto for less than 12 months, his taxable income including crypto gains would have been $335,000, and the total tax bill would have been $128,117. John needs to reserve $19,400 worth of crypto gains in fiat or stablecoin after taking the profit. This calculation does not take into account any strategies to reduce the tax bill. Now let's talk about ways to lessen the tax burden. First and foremost, good record keeping is crucial. Since crypto taxes fall within the existing tax framework, all eligible deductions can help lessen the impact triggered by crypto activities. So keep detailed records of not only all your transactions but also expenses that could be considered deductions. Specific to cryptocurrency, you should track transfer fees, the cost of acquiring cryptocurrency, fees for professional advice, costs associated with software and tools for managing your crypto portfolio, mining expenses, and any education costs related to improving your knowledge and expertise in crypto investing. Non-specific to cryptocurrency, you might want to explore strategies like personal deductible super contribution or bringing forward eligible deductions from a future financial year to current financial year to turbocharge your deductions in a year with exceptionally high tax bill. Another strategic move is to utilize crypto capital losses to offset capital gains. If you are holding cryptocurrencies that have decreased in value, selling them to realize a capital loss might be a smart move. These losses can be used to reduce your capital gains, thereby reducing your total taxable income. It's an approach that requires careful consideration and timing, but when executed properly, it can significantly reduce your tax bill. Moreover, if your total capital losses exceed your total capital gains in a given financial year, you can bring forward the unused capital losses into future financial years to offset future capital gains. Last but not least, holding on to your cryptocurrencies for more than 12 months will attract a capital gains tax discount. In Australia, this means only 50% of the gain is taxable, which can significantly reduce your tax bill. If you want to know how one can reduce their capital gains from 300,000 all the way down to the Australian tax-free threshold and avoid paying tax completely, you might want to check out this video right here. I laid down the step-by-step process in example 3. Although in this example, the gain resulted from the sale of an investment property, the principles and strategies apply to crypto as well. Thanks for watching. If you find this video valuable, don't forget to like and subscribe. See you in the next one.